As you get more senior and more of the layers of the onion get peeled back, you get a lot more tainted in what banking really is. And banking really is not about the clients. Banking is not about the staff. Banking is about money. Decisions are made that make no sense for the clients, but it makes a lot of sense for the banks.
You're listening to Because of Bitcoin, a podcast that shares the personal stories of how Bitcoin is having a real impact in people's lives, including mine. I'm your host, Mauricio Di Bartolomeo, the co-founder and CSO of Ledn. And without further ado, let's get started with today's story. Lending is older than coined money itself. Since the beginning of commerce, people have been lending seeds using goats as collateral and backing gold loans with property. With the introduction of coined money, we've seen nearly every kind of loan backed by all sorts of assets, from houses to cars to phones and even furniture. Over thousands of years, lenders, borrowers, and governments have learned invaluable lessons around underwriting, collateral management, and risk. These insights have shaped robust risk management strategies, while regulations have evolved in various countries to ensure the stability of their financial systems. Today, we're excited to sit down with the man behind Ledn's best-in-class risk management policies, our Chief Investment Officer, John Glover. With decades of experience in traditional finance, John was instrumental in crafting the strategies that established Ledn as a leader in risk management during the 2022 crisis, a time when many digital asset lending firms like BlockFi, Celsius, Genesis, Voyager, and others all went bankrupt. In this episode, we'll explore John's career in traditional finance, his journey into Bitcoin, his work at Ledn, along with his insights on where the industry is headed. I hope you enjoy the conversation as much as I did. All right, the one, the only Mr. John Glover. How are you doing today?
I'm doing great, Mal. Thanks for having me on.
My pleasure. With so much going on in Ledn and in the lending space over the last little bit, I thought it would be a great session to have with you, and you can shine some light into kind of what we've done and where we think this industry is headed. So really, really excited about our chat today. So before we get there, I usually like to start this conversation with the story behind the person. And the way I start this is by asking you to tell us a little bit about your upbringing and what it was like growing up in the Glover household. And my typical question with that is, was money or finances a big topic in your family?
Wow, that's a really interesting way to start the conversation. So I come from a family with 5 kids in it. So I had 4 siblings. And so we had a really busy household. My father was the first in his family line to go to university. So he was pretty focused on career and money because he came from absolutely no money. He grew up above a pool hall in downtown Toronto. And his dad's job was to play pool and win food stamps from other men who were playing pool, so that the family could eat. So, when I was growing up, we heard a lot of those stories. And so money was definitely a topic of conversation, and the scarcity of money and the difficulty in making money. So yeah, that was definitely part of my childhood.
Wow. So when did you first get that inkling, or when did you first realize that you were interested in money or that you wanted to go into finance?
Yeah, interestingly, that came late for me. So I studied quantum chemistry in university, and my first plan was to become a teacher. Doing some investigation into that more deeply, I realized that teachers just don't get paid very much. It's a great career, and I have a lot of respect for teachers. My wife's a teacher, but they just don't get paid a whole lot. So I decided to make the move into finance, but that was not a simple thing to do, having graduated in sciences and in chemistry specifically. And my experience for kind of 4 years after university was in chemistry. So I decided that I needed to go and do my MBA in finance. And it was from there, on campus recruiting during my MBA, that I was recruited by one of the Canadian banks. So it was, I was about 28 years old, I guess, when I started my MBA. So it was a little later for me.
Very interesting. And I think I don't think we went to the same school, actually.
Yes, we did.
As did many other people in the Ledn team, which is a great school. Go Mustangs. So you got recruited from a Canadian bank coming out of school. And that starts, I believe, your TradFi career or your finance career in the traditional world prior to Bitcoin. And you had a very illustrious career in traditional finance before you made the move into Bitcoin. Could you share a little bit about what you did in your TradFi days?
Sure. So I started out on the derivatives trading desk at TD Securities. So I was responsible for trading foreign exchange derivatives, currency derivatives. So those are puts and calls on foreign exchange, all different currencies. A lot of that was for hedging purposes for our clients. A lot of that was speculative purposes for the bank, and also hedging the bank's position as well. So that was a great learning curve for me, and I learned from fantastic mentors. And then from there, I ended up running the currency business sales and trading in Europe. And then from there, I came back to Canada and I ran the capital markets business for Barclays Capital in Canada. So it was, I had loads of fun. I loved being in the trading floor. I really learned a lot and I had great experiences. However, I also, as you get more senior and more of the layers of the onion get peeled back, you get a lot more tainted in what banking really is. And banking really is not about the clients. Banking is not about the staff. Banking is about money and solely about money. And decisions are made that make no sense for the clients, but it makes a lot of sense for the banks. And then the banks also, they download the liability on their staff, even though senior people are making bad decisions. And, you know, a great case in point is it was announced this week in the press, TD Securities or TD Bank got fined $3.2 billion for money laundering in the US, facilitating money laundering. And it just shows the hypocrisy that exists in a lot of these institutions. They knew they were doing something wrong, but they kept doing it because it was making them money. So it's, I got very jaded with that. And my move into crypto was because I met you and Adam, the other co-founder, and I loved the ethos of this company, that this company has been created to solve problems in the digital asset space for people to help them build their wealth and manage their finances on a much more even playing field, regardless of where they are in the world. And that just is the antithesis of what happens in the banking world. So it was a great opportunity for me to bring all the skills and experience that I had from traditional finance, because they're all very applicable to the lending space in crypto. But it's being done in an institution at Ledn where we really do focus on the individual client, put them at the center of everything as opposed to the money. Obviously, we want to make money for our investors. We all want to get paid. But the ethos is very much, let's make sure that everything we do is right for the clients.
That's beautifully said. And I can only imagine the things you saw in TradFi for so many years. And it's very timely that this news came out when TradFi typically tries to paint crypto or Bitcoin as where the bad things happen, yet they are the ones facilitating all this stuff. And with Ledn and Bitcoin and everything, you can track literally every transaction, whereas theirs is just a black box of things that you get, once every 3 months, you get some statement that says this is what they've done. Whereas with companies like ours, you can check these things on, we produce reports more often than them with our open book reports, and you can track activity on chain as well. So it's much more transparent and leaves a lot less room for bad behavior, if that makes sense. Before you met Adam and I, and we started talking about Ledn and you making the careers change to Bitcoin, had you heard about Bitcoin before, like leading up to that moment?
Oh, yeah. Having been in the currency world for such a long, long time, I remember in 2013, I was given the white paper and I read through it and talked to a bunch of people that were kind of very early adopters. And I remember saying this so clearly, this is bullshit. This is not fungible token. Anyone can create one. There's going to be 2,000 of these things, which I think we're probably up around that number. It makes no sense whatsoever. There's nothing backing this. That was kind of the traditional mindset that I had that was kind of indoctrinated in the banking world. It was not until about 2018 that I really started doing my research and understanding just what the use case is for Bitcoin and the blockchain itself, what the fact that it is a defined volume of Bitcoin that will ever be mined, the fact that it is speeding up transactions because the blockchain allows for kind of instant transactions, whereas sending a wire in TradFi takes 2 days, assuming that it doesn't get screwed up by the 20 individuals who have to sign off on it, and it's not initiated on a weekend, in which case it could take 3 to 4 days. So that's when I started really understanding more about Bitcoin. I still think, and I know this is an unpopular thing to say, I still think most of the other coins are nonsense and kind of bullshit. But Bitcoin, Ethereum, some of the top 5 altcoins, I'm a big believer in, and clearly some of the stable coins as well are the way of the future. So it took me a while to change my mindset, but now I'm a full Bitcoin believer. For sure.
Well, welcome aboard. I'm sure that the industry is very lucky and happy to have you. Just because of what we'll get into right now, you've gone from TradFi to becoming one of the experts when it comes to risk management in the digital asset space, and we'll get to that in a second. Maybe a way to kind of start heading in that direction is to kind of dovetail from that answer. You had found, or you had heard about Bitcoin, you were skeptical at first. Then in 2018, in those years were your sort of aha moments where you started to realize some of the use cases. And then late 2020 or early 2021 is when we connect. And we were looking for somebody to basically help us build a lending desk and instill world-class risk management policies here at Ledn. And we serendipitously found you. And I wanted to ask you if you could just share a little bit about what you saw at Ledn when you first arrived, and what were your first impressions of industry practices around lending compared to what you had been doing in TradFi.
Yeah, it was a really very eye-opening experience, because when I joined, I was hired originally, as you'll remember, as the chief risk officer at the time, and that was to really create a robust and holistic risk framework around the business. So de-risking not just credit, but also market risk and any kind of structural risks that may exist within the institution. So the first thing at Ledn, which became very obvious to me, and I think it was obvious to you guys when you hired me initially anyhow, was that we had a serious concentration risk with Genesis, which was at the time, our sole supplier of dollars if we needed them, and our sole outlet for earning yield on Bitcoin, so lending institutionally. And clearly, that kind of concentration risk has 2 offshoots. One of them is you've got significant credit risk to one individual or one institution. And the other is that you don't have control over your own economics, because they can dictate exactly what they want to pay you or what they're going to lend you at, because there's no competitive kind of pressures on them. So the first thing that I did when I got to Ledn was diversify the institutional client base within a very set framework that we had all talked about at a senior management level. To answer your other question, which was like, what was my impression of the industry? It truly was a cowboy industry. Like when I looked at what the major competitors, BlockFi, Celsius, even Genesis, what they were doing, it was so clearly evident to me that they didn't have proper risk management in place. They were lending to institutions without seeing financial statements. They were paying yield on coins that had no institutional lending or staking or any kind of way to make yield off of those coins. So the only way that they could pay yield was to swap those coins into something that did pay yield, that did have a lending market, like Bitcoin or Ethereum or stable coins, in which case they were taking very significant directional risk. And to me, it was very clear very early on that the only thing that our competitors cared about was assets on platform. And the reason for that was the valuation of the companies was a multiple of assets on platform. It was pretty much the rule of thumb was you take assets on platform, divide that by 3, that's the valuation of the business, and that's where you're able to raise funding rounds. No one at the time, the VCs and the angels that were involved at the time, weren't really looking into what the business was and the road to profitability, or whether profit was even discussed is really questionable. We didn't take that same viewpoint. We never put our clients' assets at risk. Our yield is all generated in kind. And what I mean by that is if somebody deposits Bitcoin into one of our Bitcoin growth accounts, we generate that yield by lending Bitcoin and earning Bitcoin yield. So there's no market risk involved in that, where we're taking, views on the marketplace. we put in place very, very stringent credit underwriting. So, for example, Three Arrows Capital, which is a name that people are probably familiar with, they were borrowing from everybody. And they contacted us on three separate occasions. And in each time I refused to lend to them because they wouldn't provide financial statements. They would just provide an attestation of what their assets on platform was or what their AUM was, which meant nothing at all. And in the very last phone call, the head partner at Three Arrows Capital said, "You'll be sorry. You're the only ones who don't lend to us." And right then I thought, "Ooh, this industry's in trouble." And then, of course, we know what happened there. We also, a lot of our competitors were putting their clients into DeFi. We refused to do that, partly because, I'm an older guy and DeFi just didn't make a whole lot of sense to me at the time. And so if I don't understand something, I'm not going to subject myself, our business, or our clients to that risk. And so because of that, we didn't have any of the Terra Luna problems that some of our competitors did that sent them into bankruptcy, and none of our clients lost money on that. And then we put in very, very strict credit underwriting and monitoring. And so as a result of that, during the FTX crisis and and Alameda and all the other things that went around at the time, we didn't have to halt withdrawals. We continued lending to our retail clients. We didn't have a single Satoshi or penny lost of our clients' assets. And that's what proper risk management does. So while I was being pretty negative on the banks, and I do have a negative outlook on the banks, one thing that they were very good at is managing risk, because they've had 200 years of experience in developing risk management protocols. And we brought those to Ledn and adopted those protocols. And so we run a very, very conservative, low risk business because people are entrusting us with their assets.
That's brilliant, John, and so many things to pull from there. But I think overall, like you said, when we were building the business and growing, the business was growing, and we were just growing our lending activities, we were very keen on learning from the best and learning from structures and strategies or risk management principles that have withstood the test of time. Banks have been doing this for centuries, and we didn't want to pretend that we were going to somehow rebuild the wheel that they have built really well. There's a lot of stuff that's not done right in the banks. This isn't to say that everything they do is correct, but as far as protecting money goes and protecting assets go, they were really good at that. And so that was a key thing for us, was to we believe that if this developed into the industry that it could, and it is developing today, we were going to inevitably have to sit down on a table with groups like BlackRock, with groups like Signum now, banks, and we needed to be able to speak their language. We need to look like them. We need to be able to explain things and be compatible with the way they operate. They're going to want to see that whoever's working with them is doing things equally or better. And so that was always a sort of a broad arching thesis for us, because there is no world in which lending digital assets and fiat doesn't eventually touch a bank. It's very hard to do that and bring the liquidity that this market needs without tapping into the banks. Otherwise, it's just this incestuous wheel of crypto money that kind of sits there. It just rotates like a hot ball of money. We need to bring the new money or the old money into the new world.
Yeah. And I mean, there's kind of 2 points in that. One is we actually need to be better at risk management than the banks, because the banks have the FTIC and in Canada, the CDIC to fall back on. So if they mess up and money is lost, the FDIC is going to come in and kind of bail them out a little bit. We don't have that in the crypto world. And so we have to actually be better at risk management than the banks are, which is, kind of the tenet that we operate under. And the other thing that you mentioned there, which was bringing, the banks and that kind of old money into this space, is really critical, because let's face it, they've got access to lower cost capital than we do in this space. Banks have access to the Fed window. They have access to the repo markets. We don't have that access. So being able to get access to bank funding or traditional finance funding is going to lower our cost of capital, which is in turn going to lower our lending rates to our clients. So it's a very positive step that this industry is taking now, and we've been one of the forerunners in that space for sure.
Thank you for adding that. Now, so you walked us through some of the traditional finance experience you had, you walk through, you come into Ledn, you see this industry that's basically running without a lot of these principles. You bring some of those principles or all of the best practices that you've brought from TradFi, we install them, we implement them here at Ledn. Those guardrails or those principles and those policies it basically are key, pivotal to help Ledn navigate the turbulence that was 2022 when everything collapsed. And I always like painting a picture on sort of how each policy addressed each one of the events. And I think, the way I say it is, by making a decision early on to not invest client assets in DeFi yield farming is how Terra Luna didn't impact us. By having stringent underwriting policies is how Three Arrows didn't ever get through our desk. And by having concentration risk is we were able to mitigate the collapse of the big lenders like Genesis and Alameda. And so I think those are three great examples of these policies in action and doing what they are supposed to do. That said, all those events provided a lot of new information, a lot of new learnings, and a lot of lessons that the industry and Ledn and everyone learned. Can you talk to what Ledn has done since to apply those learnings now that we are leading the market in order to cement this position?
Sure. Yeah. And one of the big learnings for me, and again, this is something that just doesn't exist in traditional financial markets, is the need and the demand from our clients for transparency. And so, when you put your money into a bank, you have no idea what's happening to that cash. You know it's being lent out, but you don't know how much is being lent. You don't know where it's being lent. You don't know how much is being invested by their prop trading. You don't know how much is going into different asset classes within the institution. So you don't know what the risk is being taken. Our clients, because of what happened to Celsius and BlockFi and others, and they got caught, some of them were clients of both, and they got caught up in bankruptcy proceedings. They are now much more educated. They understand a lot more about, what the risk is of investing their cash or taking, borrowing and posting collateral to institutions like ourselves. And they want as much transparency as we can possibly give to them. So one of the things that we've done is we've created the open book report, which continues to get more granular and at some point is going to be live on our platform. Right now we put it out monthly, but it'll at some point be live, and that gives people the understanding of what's going on with the different products that they interact with at Ledn and how we're generating yield or what we're doing with their assets. The other thing that we've learned is that clients want to get away from any chance of losing collateral when they borrow from an institution. And the only way to do that is to go to what we call a custodied loan. So in our standard loan product, we have the ability to lend the collateral out institutionally. That lowers the standard loan rates down from where they otherwise would be. In the custody product, we don't lend those out at all. So those are all sitting in custody, in Ledn's name. They can't, your risk of a lending loss from an institutional loan is mitigated. And so that gives even greater security to the borrower who's looking for that kind of security. We have seen recently that about 40% of our new loans are going into custodied loans. So people are willing to pay a slightly higher rate for that security and that reduced potential of losing any of their collateral. I think that's going to continue moving in that direction. When we first introduced the custody loan product, it was about 20% of our new loan origination was custodied. Now, as I said, it's about 40%. I think that's going to continue going. And I can see a world in which we don't even offer standard loans anymore. If we can get our cost of funding down enough that we can get the custody loan rates down, then I think it'll get to a point where people will just say, listen, I'm willing to pay a slightly higher rate than I could get with your competitors because I have virtually zero risk of loss of my collateral. So that's another thing we've done. One of the big learnings when we looked at what happened at some of the other of our kind of colleagues in the market, like BlockFi and Celsius, was if you were interacting with their growth account product, you were exposed to anything that may happen in their lending product or in their yield generation products. And we heard loud and clear from our clients, if I'm borrowing from Ledn and I'm posting collateral to Ledn, and there's some sort of blow up on your growth accounts, I don't want that to affect me. And that's absolutely fair. So what we've done is we've put these kind of firewalls around each one of our products now. So if you're interacting with our growth account product, you are not exposed to anything that happens in our lending product and vice versa. That's been something that's been very well received by our clients. They just didn't want to have that exposure. So they want to have complete and utter clarity on what's happening with their assets when they're interacting with Ledn. So we've made a lot of changes, and there are more to come. Like, we are always trying to improve our risk management, trying to improve the products that we offer to our clients, and that's a bit of an iterative process, and we're going to get there as quickly as we can.
I love when you can get to articulate what we've done in terms of, because a lot of that stuff is happening behind the scenes. A lot of clients, they're not necessarily net new products that people can look at and poke around and interact with, but they are instrumental to keeping your Bitcoin safe. A lot of things that are, I think, a lot of critical things that we kind of take for granted in our day-to-day life are these things that happen behind the scenes. I wish that there was an easier way for people to see this type of work, but this is why we're always out there trying to communicate what we're doing so people can articulate or people can understand, rather than having to go through some dense T's and C's document.
Agreed. And that kind of transparency is something that you don't know you're lacking until something happens, right? I was recently at a conference where I was talking to an ex-senior person from BlockFi, and he let me know, and I was unaware of this. I don't know if you're aware of this, Mel, but BlockFi used a third-party technology for all of their LTV monitoring and liquidation management. It was not in-house. So they had lots of instances where they were unable to transact because the third party went down or there was a problem with their software. They didn't control it. Unlike Ledn, where we've built it all in-house, we're completely in control of it. If anything happens to it, our team is there right away, making kind of any adjustments that need to be made. And our technology has never failed. That's something I didn't even know existed at BlockFi. So there was no transparency. And there was no communication to the clients. All their clients thought that they were dealing with BlockFi, but they were actually dealing with some third party who was managing their collateral.
Well, my understanding was that they did use the third party to manage repayments and things like that, or administrative things, but not the actual risk engine was completely outsourced. That is
crazy.
Very scary news to me. And as you mentioned, it's a great time to mention that we have built and own all of our tech, and it's battle tested to the nth degree, as John and even the volatility before John demonstrates. You mentioned bankruptcies. A couple of points on that. Number one, a lot of those bankruptcies, a lot of people that were in those bankruptcies have been grateful to Ledn for being. A lot of people had assets in different platforms, and Ledn being the only one that didn't go. And they've sort of said, I wish I would have paid more attention to proof of reserves and things like that. We were also able to help some people in the Celsius borrower cohort to refinance their loans out of bankruptcy and avoid potential, extra tax burdens and other things. And so we brought in, I would say, up to 70 or plus % of the book that Celsius clients that wanted to refinance, which is, I think, a testament to market preferences and people having learned their lessons. And we are about to see distributions commence for the FTX bankruptcy. And a lot of investors are going to be getting a lot of money back. And some of that's going to find its way back into the market. These products, I like to say, loans are non-discretionary. People don't wake up one day and say, it's a great day to take a loan. Things happen to you, and you look at your portfolio and you say, this is the best use of my capital. And you end up going to a loan. Now, with all that said, where do you think this industry is going? What do you think the future of this industry looks like? And I know there's several types of loans and they might have different paths, but let's start with our flagship Bitcoin-backed loan product.
Well, the thing that I really hope for is that people don't have, when the FTX or the Celsius and the Voyager and all the bankruptcies that happen get too far back in the rearview mirror, that people kind of forget what caused them. And then they start thinking that every loan product is the same and every lender is the same. And that's what we used to see. We used to see people come and say, well, BlockFi is offering me a loan that's 25 basis points less than yours, so I'm going to go with BlockFi. And we would always say to them, just please do your due diligence, see what BlockFi is doing, see what their risk management practices are. Ours are very transparent. We have we're very open book. And people would just choose the slightly lower rate, not realizing that they were comparing apples to oranges. And I'm hoping that as we see more companies come into the space, which is healthy, we're happy to have competition in the space. I'm hoping that people ask all those questions and really do their due diligence, all these new companies, because there are companies out there that also were around during the 2022-2023 crisis, but they did freeze withdrawals, or they did stop lending, or they did have big losses, which they forced their clients to convert into equity in their business as opposed to pay them back. Ledn never did any of that. Everybody got every Satoshi. If they wanted to repay their loans and get their collateral off our platform, they were able to do that. This competitor I'm talking about, you were stuck and you're now an equity holder in that company, and you may or may not get your money out in 5-10 years in the future. And others that are now around weren't around during that period, so they've never experienced what happened then. And so we don't know if their risk management practices are strong enough to have them survive that if it happens again. And one thing I would say is there is going to be another event at some point in the future that's going to shock the market. And if you don't have proper risk management policies and procedures in place that are absolutely followed to the T, your company is going to get hurt by that event when it happens. Ledn is not going to be in that position because we are doing everything we can to avoid that. So when you ask the question, where's lending going? The Bitcoin-backed loan product, I think, is going to continue to grow. I think it's going to continue to grow exponentially. If you look at the size of the market 2 years ago, we're nowhere near back to there yet. Before the BlockFis and the Celsiuses went bankrupt, we like to look at this and compare it to the mortgage marketplace. And if we look at houses, 60% of houses in the world have mortgages on them. So if 60% of Bitcoin was used as collateralization for a loan, just as houses are, there's hundreds of billions of dollars of potential in this marketplace. So I think it's going to continue to grow. I think there'll also be Bitcoin ETF units that are going to be used as collateral. So that's going to be something that's going to change. That poses a challenge to lenders like ourselves, because those markets are not open 24/7 as Bitcoin is. So it's tough to monitor LTVs of loans when the market's closed at night or when it's closed on weekends. So there's going to be challenges involved in that. And so when people start offering that product, you've got to make sure that they really know what they're getting exposed to, so that there's not some risk event that they're not expecting. So I think, to answer your question, market's going to continue to grow. Competition's going to grow in the space, and hopefully there'll be really good companies that come in this space, and it'll be a positive for the whole industry.
Beautiful. Yeah, I think this is going towards more transparency. I think that's Bitcoin's edge. We are now going to win against the banks on cost of capital. We have to win on transparency and better execution, and the cost of capital will come because capital chases capital. One question that I wanted to ask you, which I think is pertaining to custody loans, and which I'm personally very, very proud of and grateful for you and the team for leading this. But you recently led Ledn's deal with Sygnum Bank, which was the first ever syndicated Bitcoin-backed loan to a Bitcoin-backed company, which I think really is a testament to the quality of your efforts at the desk, and Ledn sort of, Ledn as a firm and the level at which we operate. Can you speak a little bit about that deal? How is, what's that structure like? What's unique about it? And what do you think this unlocks for Ledn?
So this was a really exciting deal to be a part of. And this was with Sygnum Bank in Switzerland. Sygnum had been approached by others to do syndicated loans, and they turned them down in the other cases because they just didn't think that the company that was asking for this syndicated loan was of significant enough reputation for there to be interest in the traditional finance market, because those are the people who are backing the syndicated loan. So a loan syndication simply means you've got a bank that's going to find a whole lot of other investors who are going to go into this loan with them. So they're syndicating parts of this loan out to others. And Sygnum was very happy to do that with Ledn because of our history. They did a very, very deep dive on Ledn. on our total history. They went back to 2018, all of our loans, how many loans we did, how our risk engines operated, what our risk management policies were, et cetera. So it was really exciting that they took this on, and they were able to bring a bunch of traditional finance players into the loan syndication who had never invested into the space before. And that's really exciting. So one of the things that we've been doing, you and myself and Adam, we've been talking to a lot of traditional financial companies, whether they're credit funds or other banks. And it's a very long educational process for them to understand what Bitcoin-backed lending is, but really to understand the pristine nature of Bitcoin as a collateral asset, because it's got deep trading markets. It trades 24/7. There is no kind of price gap risk that exists on weekends when you're looking at a Tesla stock as a collateral asset. So they're moving up that learning curve, and with the Sygnum name, we were able to move up that learning curve more quickly with a number of these institutions. So that was really exciting, and it really has opened the door to other financial institutions in the traditional markets to move up that learning curve more quickly and consider some funding loans for Ledn, which allows us then to, again, as I said, lower our cost of capital, which means we can lower our lending rates, which we did just recently for our custody loan product. And so it's going to continue opening the door for traditional financial players to come into this space and help us to meet the retail loan demand that we have at Ledn, which has been exceptional.
That's brilliant, and it's been fascinating to watch the evolution, because this, we've been trying to basically make banks and bigger financial entities open their eyes so that they can participate in this, lower the cost of capital for us and Bitcoiners, and make this, have liquidity enter the market. And 2 years ago, you can attest to this. Banks wouldn't pick up the phone. They wanted to do nothing. They wanted nothing to do with Ledn. I mean, and other crypto firms outside of the signatures and the Silvergates that we know what happened to them, unfortunately. But outside of that sort of caucus of pioneers, there were no real banks trying to come out and enter the space. And they've left this void, and other banks are taking are now jumping in. And I like to say to people, banks aren't coming. Banks are here. It's the days of the institutions are coming are far gone. The institutions are very much here, and they're going to keep showing up. So it's fascinating. It's great to see or to know that there is somewhere out there a secondary market for a Ledn bond, or a bond for a loan issued to Ledn backed by Bitcoin. It's fascinating to see how things are moving, how fast things are moving.
Yeah, it's exciting, and you talk about 2 years ago. When I first joined Ledn, my network of colleagues or former colleagues in banking, they all thought I was insane. They were all saying, "Why would you join a crypto company? You're going to be out of business in a year. It's an assets. It's not going to stick around. Regulators are going to shut everybody down." And now those same people are calling me saying, "Hey, I want a meeting to talk to you about providing Ledn with funding loans," because they now want to get involved in the space. They realize that funding into this space, because they're very risk averse, right? So they're funding in this space. We're posting collateral to them in order to get these funding loans. They're now understanding what the value of that collateral is in terms of security, and so they're comfortable in lending to us at lower levels. And again, that helps everybody. So it's been a complete turnaround in the last 2 years. Interestingly, because we had a huge blow up last year, right? And so you would have thought that was going to set us way back. Instead, what they've been looking at Ledn saying, "How did you guys survive? Explain to me how it is that you were able to continue operating without a hitch when everyone else was going bankrupt." And once they saw that we've got traditional financial risk management policies and procedures in place, they're like, "Okay, we're no longer considering you this hugely risky digital asset business. We're now considering you a retail lender in an over-collateralized way, like auto loans or other kind of retail lending companies." And they're like, "We understand this business because we understand your risk management, so we want to get involved." So it has been a complete sea change. It's been a 180-degree turn. It's been great.
That's brilliant. Well, we'll keep them coming, and we'll keep your loan rates hopefully getting lower and lower so that everyone can take them and do more things with them. Switching gears for a second, the other side of the house is Bitcoin yield. And there's been a lot of action on that part of the house or in that part of the industry, I would say, with groups amassing very large balance sheets of Bitcoin. And, everybody has a question mark on whether what they plan to do with that Bitcoin. Some have made out statements. And I just would like to get your view on where you see that part of the industry going, and what are Ledn's plans?
Yeah, that's a great question, and I've had this from a couple of people. Because you've seen the Michael Saylors of the world come out and say that they want to earn yield. We've been approached by a couple of the ETF providers who are now saying, we've got huge amounts of Bitcoin now on our balance sheet because whenever they generate an ETF unit, they have to buy a Bitcoin to back that. So now they've got all this Bitcoin sitting there, and they're all saying, we want to earn yield on this. So my assumption is that we're going to see a lot of this Bitcoin start to hit the lending market. So they're going to be lending institutionally. And as they lend institutionally, those volumes that are coming in, it's going to drive down yields. And so people who are earning yield on their Bitcoin today are going to probably see those yields decline. And that's just supply and demand in the market that's going to drive that lower. And I think it'll get to a point, there's going to be a floor on this, because it'll get to a point where people are going to say, I don't care about earning, 0.5% on my Bitcoin. I'm not going to bother. And I think we're going to get driven down until we find that equilibrium point. But I think we are going to see these yields start compressing, and they're compressing now. Like I speak to all of the institutions that have gone through our credit underwriting, and we consider them the highest credit quality institutions in this space. They're all market makers. They're all non-directional market makers. So they're not taking, directional market risk. They make their money off very small bid offer spreads, but huge volumes. And they're the institutions that we lend to. They're being approached now by some of these very large holders of Bitcoin to borrow from them. And they're saying, these rates that they're offering us are quite low. And so we're already seeing that rate compression come into the space. So that's going to impact the Bitcoin yield. I think that's going to be driven down for people. We are seeing some of these wrapped Bitcoin staking that's coming into the marketplace. Again, I know I shouldn't use bad language, but I think that stuff is bullshit too. So you've got wrapping and unwrapping costs, but you've got bridging risk that comes when you're doing the wrapping and unwrapping. And you're staking a coin that's a proof of work coin. So it is being manufactured, this yield, through tokenomics. And I think it's a whole lot of nonsense myself. And so people are going to move into that area to earn additional yield. Just know that you're taking on additional risk to do that. So if you're going to go and have your Bitcoin wrapped and earn staking yields with your Bitcoin, know you're taking on some risk in doing that, and just be aware. And then it's also going to affect the lending rates for Bitcoin-backed loans, because the reason that we can show lower rates for our standard product than for our custody product is we can lend that Bitcoin institutionally and earn some yield, and that makes up that difference in our economics. As those borrowing rates for institutions go lower and lower, the difference between custody loans and standard loans is going to keep compressing until the point where it may be just not even worth having standard loan product available, because I think the custody loan is much safer and it's going to be at a similar rate or slightly higher. So if people really look into that difference, they'll logically opt for the custody loan, because there's not going to be that much difference in the rate as these borrowing rates institutionally keep being driven lower.
John, you said that like a true crypto OG. You talk about wrapping and unwrapping costs, bridging risks, proof of work getting wrapped into proof of stake. Look at you go.
Who says you can't teach an old dog new tricks?
So I want to switch gears, because you've been in your currency world. You've been through a lot of politic changes and how that impacts markets. And whoever says they don't impact markets just hasn't been through enough cycles. I wanted to ask you, I'm sure everybody wants to hear your thoughts on this, but we have a pivotal US election coming in just a few weeks. By the time this airs, we'll probably be just days away, or probably right after it. How do you think the result of the election could impact our industry?
Well, certainly the expectation is that if Trump gets in, it's going to be very positive for Bitcoin. And if Harris gets in, it's going to be less positive and possibly even negative for Bitcoin. I think that is hype that has been kind of driven by kind of the blogosphere. I don't necessarily believe it's true. So if we look back only 2 years ago, Trump was saying Bitcoin needs to be hugely regulated. It's a terrible asset. It's being used by criminals. We will never support Bitcoin. Now he's flipped because he's seen pressure from the voters, because 20% of Americans or 22% of Americans hold Bitcoin now. So I think he's just seen pressure and said, hang on a second, we now love Bitcoin and we're going to make sure that it's easy, and Gensler's going to get out of there, which he probably will anyhow, and it's a good thing. But so Trump is making this all about, how he's a super supporter of Bitcoin. I don't believe that he is a super supporter. Trump will say whatever he needs to say to get headlines. Harris has also been saying positive things about Bitcoin and about digital assets and the blockchain in general. So my personal view is, well, probably if Trump gets in, we see a jump in Bitcoin. If Harris gets in, we maybe see a dip, but I don't think it changes the overall trajectory of Bitcoin. I think they both recognize that digital assets, Bitcoin specifically, and the blockchain are here to stay, and they're going to put in place policies that regulate it, but in a favorable way. So I think that either party is going to be positive in the long run for Bitcoin. It's just what happens in the 24 to 72 hours after the election results. There may be a difference in that.
I echo that. For what it's worth, I echo that. I think that both won't really impact the long-term thesis. I think if one thing's true, both parties, no matter who wins, are going to run deficits. That's just a reality. And the other thing is the Fed has got to continue easing because the restrictive rates we're seeing are just not going to work for anyone long-term. So really, Bitcoin's just a function of a fixed numerator with an infinite denominator, and it's just going to go up and to the right. Or actually, the opposite is the opposite.
It's the numerator, fixed denominator. It is 100% going to go up and to the right. I feel that very strongly. The time frame on that is a little bit difficult, and there's going to be ebbs and flows. Nothing goes in a straight line higher. Corrections will always happen, but I think that in general, if you look back in 5 years' time over the previous 5 years, Bitcoin is going to be trending higher during that entire period.
Well, yeah, that's a big reason why we bet our careers and our day to day to building this thing out, because I think the future can be much more transparent and accessible for people. We haven't even got into how we do this thing more, we do this more efficiently than TradFi, which is dispersing loans around the world. I don't think a single bank can say that they can process loans in the manner that we do here at Ledn. We're coming up to the end of the show, and I want to ask your now famous Bitcoin TA that you publish every Friday at Ledn. Can you explain to our readers what it is, what this TA chart that you put out and what you highlight every week in your charts for those that might be new to it?
Sure. So the whole theory behind technical analysis is that there's patterns in any tradable asset, whether it's bonds or a stock or a currency or Bitcoin. And so if you look back at the historical chart patterns, they repeat themselves. And so if you understand what typically happens after a specific pattern, then you can kind of forecast where things are going to go. And the specific technical analysis that I subscribe to, and I've been analyzing markets for over 25 years using, is called Elliott Wave. And Elliott Wave, in its simplest form, says in the direction of the trend, there will be 5 waves up, and then there'll be a corrective 3-wave move down. And then there's all sorts of rules within each one of those waves. And this goes back to the Dow theory from the 1700s. So this is like not brand new, but it is a whole area of technical analysis that is focused on by many people smarter than I am. But so when I look at the technical analysis for where we are today in Bitcoin, we are in what's called wave 4 of wave 3. So I said it goes up in 5 waves. We're in the middle of the 3rd wave higher, nearing the end of it. I suspect if we break above 66,000, we're going to break above 73,000, which is going to take us up to 87 to 93,000. Then we'll have another correction down into the 70s, high 60s, low 70s. And then we launch towards the end of Q2 of next year. We launch up into having a 6-figure price on Bitcoin. I look at this very closely. I look at it every single day, and I analyze all the little waves within the bigger wave patterns. And I'm quite confident that's going to be the case. I'm just not sure when we break that 66 and 73,000 level. Do we test 50,000 first? We may. That still doesn't change the trajectory. The thing that would change the trajectory is if we break down below 49,000 before we break above 66,000. So that's the only thing I'm nervous about. It's not my favorite outcome for this. I still think we're going to go higher. But there is that risk that if the market gets themselves convinced that a Harris victory is going to be terrible for Bitcoin and everybody starts selling their Bitcoin, if the Democrats get in, then we may push down through that 49,000. That could wreak a lot of havoc in the marketplace. But I don't think that's going to happen. But there is that potential.
Well, you get, if you're listening, you can check out John's chart every Friday and just follow the Ledn account, Ledn X account, and set up your alerts for Fridays. The last one is an easy one. Where can our listeners find out more about you and your work?
Oh, is that an easy one? I don't know. I'm not really that active on social media. But you can see all my background on LinkedIn, so you can see all of my experience that I've had in the marketplace. I am on X every Friday, as you said, and you can also reach out to Ledn, and we've got my bio. You can find out what my history is, and then if you want to talk to Mao and have a call with me, I'm happy to do that too. So,
brilliant. Well, thank you, John, for taking time out of your busy week to explain or illuminate a lot of our investment and risk practices here at Ledn. Really appreciate it.
That's been fun. I'm glad that I finally got on your podcast, Mao.
I've loved getting to know John over the years, and I think he did a great job articulating the work he's done at Ledn and how much our industry has evolved over the last 24 months. As the saying goes, those who don't learn from history are doomed to repeat it. Everything we do today, where we eat, how we dress, the medicines we take, have been informed by our collective experiences and learnings throughout thousands of years. Money and lending is no different. While there are a lot of things from the traditional financial system that can be improved upon, it's important to recognize that TradFi has absorbed centuries worth of experience when it comes to lending. JP Morgan has been in business since 1871, Wells Fargo since 1852, Bank of America since 1904. These firms did not become household names just because they were banks. There were 20,000 banks in the US in the 1900s. They became household names because they withstood the test of time, and they have done right by their clients over centuries. At Ledn, we believe Bitcoin will outlive all of us, and we want our firm to do the same. As you heard from our conversation with John, we invest a lot of time into improving our risk management policies and ensuring that they evolve with the market structure and regulatory frameworks. Operating the firm at the highest standard possible is what has allowed us to work with banks like Sygnum and others to move the industry forward and bring much needed liquidity to Bitcoin and the digital asset space. John has been busy here at Ledn, so stay tuned for more updates, and also stay tuned for another great guest in our next episode. Thanks again for listening, and see you soon. If you enjoyed this Because of Bitcoin episode, I would be very grateful for the 5 seconds it would take you to drop us a review and give us a rating on your favorite podcasting platform. This will really help us reach even more listeners. And if you'd like to learn more about Bitcoin, be sure to check out our newsletter by subscribing at ledn.io. That's ledn.io. Again, this was Mauricio Di Bartolomeo. Stay tuned for our next episode. And until then, muchas gracias y los quiero mucho. Chao, chao.